What's up, guys? Ron from Rohde Law. In today's interview, I'm really excited to sit down with my friend and colleague, uh, Roger Waggoner. He is head of acquisitions at Cantex Capital, which is a Dallas-based private equity family office. They've transacted 4 million square feet, or what is that so far?
So I think right now we're closing out on 6 million square feet life to date, and a big chunk of that right now has probably been the last 27 months. Since kind of end of 2020 and beginning of 2021, things have really started to hockey stick for the firm due to the great leadership.
That's awesome. That's great. So we're going to be sitting down. We're going to have a conversation about direct experience at Cantex and how that can apply to you as an investor starting off in the most important section, which is acquisition. So thanks for joining us and tell us a little bit more about your background.
Yeah, thanks for having me. Background, so I went to school in Los Angeles and moved out to Dallas with my family. My family moved here about 2004. I moved out here in 2007, a few years later. Started with the Deloitte firms on the accounting side with a focus and emphasis on primarily real estate firms and real estate investment, REITs at the time were very active, and obviously coming out of a 2007 era, there was lots of transactions, transaction volume was high, so there's lots to do in that sector. Shortly after joining on the accounting side, I had an opportunity to join the real estate transaction advisory group at Deloitte, which is the real estate consulting group from a legacy perspective. And then after that, had the opportunity to really transact across the globe. I think I transacted in 19 countries, in every asset class under the sun, everything from multifamily to hospitality to single tenant, triple net, and then up to regional malls and everything in between. Later in my career, I focused on data centers and multifamily with somewhat of a special use industrial mixed in. And I think after I'd been at the Deloitte firms almost 14 years, met the founder of Cantex Capital, Romy Chima, through a mutual friend. We had a great conversation and kind of things have skyrocketed from there.
That's great. That's great. So I like your path. You've started in something which is, I think, more accessible, more traditional, which is accounting or tax, but it's always been real estate focused, and that's kind of my own career is I've always been in real estate, and I've known that from the very beginning. It's law. It's taken different shapes, but sounds like you just love real estate.
Yeah, family has a background in real estate. I have a brother in construction, and so I've been around construction or real estate essentially my entire life, and do have an affinity for it and something I love doing. So blessed with the fact that I get to do what I love every day.
That's great. That's great. So tell us a little bit more about what you do on a day-to-day for Cantex. It's acquisitions, right? But what does that mean?
Yeah, so acquisitions, and I think at Cantex we think of acquisitions a little bit differently. At most traditional deal shops or real estate investment shops, an acquisitions focused professional might only be responsible for pipeline or for kind of transaction coordination, closing the deal, financing a deal, equity. There's so many different components and aspects that go into actually
and maybe to
acquiring
cut
real
you
estate.
off. So what I'm going to kind of explain is it's a deal flow from the very beginning time you reach out or the first time you see a property address. There's reaching out to the broker or the seller directly, negotiating, even getting it under contract. And all of these are handoff points that sometimes you're saying sales, cold calling, acquisitions. At some point they can drop off. And another common break point is once it goes under contract. That's when it switches from acquisitions person to maybe a transaction coordinator or transaction manager to see the deal across the line. And all of these points, after closing, again, is another cleave of handing the baton. So just for everybody watching, those are common break points, but how does Cantex do it?
Yeah, so Cantex operates a little bit different. So yeah, we can start and after we run through kind of how Cantex does really look at the acquisition and real estate investment life cycle, we can go back to how do you get started? What is the very beginning of the process? At Cantex, we have all of our acquisition team really involved throughout the entire life cycle and hold period of an investment. So it's everything from deal sourcing, initial underwriting, getting the deal under contract, negotiating a PSA, going to title, looking at physical and financial due diligence and completing that process through close. And then really, we're, to your point, handing it off to typically an asset manager. What's unique to us at Cantex is we have all of our deal professionals stay on and involved with the deal through the entire asset management lifecycle and honestly through disposition. That enables us to really execute business plans that were developed by the acquisition professional at the beginning, and really see that through fruition. And they have key responsibility for overseeing the construction and kind of construction management of maybe a make-ready or a complete renovation of the property, releasing the property, or ultimately selling it to a user if that was the strategy. And so taking that full perspective and full scope view at an acquisition level is unique to Cantex. Now, taking a step back and going to the very beginning, how do you find a deal? I think real estate, and I think most people have figured this out, real estate's it's a relationship business. While I could sit there and go back to my office and cold call 8 or 10 hours a day, probably not the most efficient use of my time. So what we try to do is build good relationships, and we believe that because we operate right now primarily focused in DFW within an hour of our office, we are focused on building those relationships of the most active brokers in the market. So for someone starting out, if they're looking to find opportunities to buy transactions, to buy deals, I would say, building relationships, getting out in the market, figuring out who's the one broker that's maybe most active or one of the most active in a market that you'd like to purchase in, that's really a key point, because as maybe a single man show, or even if you've got a couple buddies or friends or colleagues that you're going to try to buy investments with, you just can't make as many calls as a dedicated broker can with the subscription and data sources they have. They can go look at a property, they can call everyone on a single street in an hour. You may spend an hour finding a single phone number for an owner if you're looking at maybe a tax assessor website and trying to search the ownership and Google Ninja to find yourself a contact or point of contact. So building relationships, I think, is the first key. We rely very heavily on our relationships. I would say probably about 85% of the deals that we are currently acquiring and have been acquiring for the last 24, 27 months have all been off market. So we're not traditionally buying deals that that are on CoStar or LoopNet or Correctly or other sites.
These are still coming from your broker relationships.
That's correct. Yep. So the brokers are cold calling and they're finding off-market opportunities, and before it goes to market or whenever they have a seller that is open to looking at an offer, or perhaps even has recently thought about selling an asset or an investment, we try to make sure that we get the first look.
That's great. That's great. And I think, investors have to really view it as a long-term relationship, that you're investing in the broker, but the broker is investing their time just as much with you. And so it really is a two-way street. I feel like people are maybe intimidated to reach out to the most active broker, but the thing to remember, we're recording this now, is June 2023. The market has slowed down, and even the busiest guys will give you a conversation or a phone call. And if you have capital and you're still, interested in buying, they're going to talk to you.
Yeah, and I think that's right. And I think, look, there's some sense of, if you're doing your homework, if you're putting in the time, energy, and work to be focused on an area, to know a little bit about what you're buying, don't come in completely blind to either market norms, trends, pricing. If a broker comes and says, look, I've got a great off-market deal, it's going to be $115 a foot, and you look at your underwriting model and you're so conservative, you're looking at maybe CoStar rates, rental rates in DFW from 2020, there's a significant gap between where rental rates were in 2020 and then where we're at summer of 23. And so if you're using stale data for your underwrites and you're only able to get to $85 a foot, you're not closing the gap, and you may be discredited by most brokers because they don't want to deal with someone who's not putting in the effort, the time, and energy to bring themselves up to speed. So I would say focus on a market, focus on an area, get smart on whatever's going on in that market. Who are the tenants looking for space? What does the vacancy look like? What is demand? Are there users coming in there and buying and boosting up values? Who's buying the buildings and what is transacting? And what do those recent transactions look like? And just have that. And if you don't have that data or don't have access to that data, ask these questions, formulate a list of questions to where a broker can at least provide the information, and just make sure you're trying to ask the right questions, and so you're not wasting your time or theirs.
Yeah, I think I'm most impressed by some of my clients who are very flexible. They can pivot very quickly. So in your example, and I like it, where the broker says off-market opportunity, 115 a foot, got some vacancy, multi-tenant, the Class B light industrial stuff people love, and you're underwriting rents at $9 a foot, $8 a foot, and you're like, this. If he says, oh no, there's really good comps, I think I could get you a tenant in at 12, those people that can very quickly update a value, do you do that type of flexibility where you're changing your underwriting based on maybe new information? Obviously, we take everything a listing broker says with a grain of salt, but that would help overcome that hurdle. If I have bad information and the broker says, no, you're way off, this is what it should be. So, okay, if that's that, I'm still not going to pay 115, but could we do a deal maybe, or offer at 112?
Yeah, no, I think it's that goes back to knowing your market. One of the things that we've been very focused on at Cantex is knowing every submarket within DFW. And as large as our footprint is, we've transacted full cycle a large number of deals, I think right around 2 million feet right now, and still have almost 5 million square feet under ownership. And so within the specific submarkets around DFW, we're constantly getting asked, why are we not yet in San Antonio or Houston or Austin or Denver or some of the other fantastic markets around the US? And the fact of the matter is right now we're so hyper-focused in DFW that we want to know who are the leasing brokers, who are the investment sales brokers that are focused in these markets. We want to have the best comps, the best data, and we really try to use data to our advantage, because there's a lot of other investors that are not as hyper-focused on a particular market or submarket. And so by doing that, I think anyone on our acquisitions team needs a napkin, a pen, and 90 seconds to underwrite most deals in DFW, because we're breathing it 5-6 days a week, and we're just doing that all day, every day within one particular market. And so it's very easy for us to know what deal closed, what deal leased, and how long it took to lease. And for the most part, I think in any of our submarkets, we've got a large number of brokers that are a text message or phone call away for good, reliable data. And oftentimes data may be reliable than any of the other public sources or even subscription sources available. So yeah, having that data is important.
I'll give a little plug. I do a DFW industrial submarket survey of Dallas, and I think I give you guys a shout out for Brook Hollow. Okay. But it's fascinating how hyper focused. You guys think you're hyper focused, and then I know people that are only buying on certain streets, because you have to reduce your sphere of expertise to something that's manageable. And for you guys, maybe it's all of DFW. For somebody else that's listening, they may only be able to spend the time to be the expert and say, these are, 24 square miles, and there's 100 properties that kind of fit. And I know every single owner, and I know the last time every building sold, and you just shrink it until you have that mastery. And then you have to be patient, wait for a deal to pop up, and you'd be like, okay, I know exactly what the comps are, I know what it's worth, I know what it could lease up for, this is my upside.
No, I think that's exactly right, and that's probably great advice for someone who's just starting out. If you know exactly what properties are renting for, how long they're on the market for, what is the required make ready, if you go act as if you're a tenant and go tour some of those properties, look at what does a make ready look like, kind of estimate what is the construction cost to get paint up on the walls, to LED the office, LED the warehouse, do a basic make ready, and knowing those costs and being able to build that in the model, and not just always estimate a conservative number saying, look, I think it's going to be a $10 TI or a $10 make ready to convert this old tired space into something that's refreshed and relatively new and attractive to a user, but knowing that it's $6.50. And knowing that, and having talked to contractors and seeing the build outs firsthand, and knowing a particular street, like you said, I think knowing that enables you to just identify a deal when one hits you upside the head. Because a lot of times you get a deal and everyone's first reaction is to, okay, you want 115, well, I'll pay something less than that. If you're asking 115, it must be worth something less than that.
Yeah.
Where sometimes I'm getting deals and I'm making a deal at $100 a foot, and I know at 103, it's a steal. I would have paid 115 for it. So I'm not going to say anything. I'm going to jump on it, and I'm going to have, maybe a PSA drafted instead of an LOI, and I'm just going to try to go straight to contract within 24 hours.
At full price, at full asking.
At full ask.
Yeah.
And just try to avoid anyone else seeing it and just make sure that I can get control. But unless you know the market really well and you have that level of confidence, you don't have the ability to make a quick decision and jump on an opportunity when it does come to you. So I think that's great advice. Focus on a small area, a sub-market, a couple streets within a sub-market, become an expert there, drive the street. And I think even from a broker perspective, if I think about the most successful brokers that we work with, they are hyper-focused. They know every address, they know every building, they know when it transacted, they know who's in there, they know the ownership history. And those are the brokers that can recall. They don't need to look it up. They can just recall it, be like, oh yeah, no, I've talked, they'll never sell. Or this is what happened, the owner passed away, I think they're gonna sell in the next 6 months. And they constantly are checking in, and when you find those brokers, they're invaluable.
Yeah, and the comment about brokers, I think, is really true, because you want somebody, you're paying them a large amount of money for their expertise, and the more that they can convey that to an investor as a buyer or purchaser of their services, the more that I think things are going to flow, because you're acknowledging their fee, you're happy to pay them that fee on a $3 million deal. You pay them $100,000. It's well earned for those people that really have all that knowledge and can tell you, I know this guy, this is what they did to it, this is how much they spent, this is what they're trying to exit for, but this is their debt on it. And it's so complicated, the origins of ownership and what their motivations are, because I think a lot of times too, sellers are not always motivated by just absolute price. The sales process is stressful. As somebody who's going through that personally right now, actually, well, we're under contract now, so it's like we breathe a sigh, but I'm still like, oh God, now we still have to. Yeah. There's still a lot more work.
Till the money's in the bank.
Well, I saw that calendar for the closing date, and I was like, holy cow, that is quite a ways away. And they try to beat us up on DD periods now, and the market has just really shifted. And I think we're still getting deals done, but the leverage has certainly tilted more back towards the buyers. And so they wanted a long DD, and they wanted like 45 days to close. And I was like, what is this? You guys have the money? You should close in 15 days. And they're like, no, we want this.
Yeah.
But I guess the point is, there's so many variables. That's not just price. And I feel the same way. I'm not just absolute price, because if somebody came in, the proverbial all cash offer, but they said, oh, you already have an Alta? Oh, you've got a phase one? Great, we're fine. Give us the leases, 15 days, DD, it's a small little property, we'll close. That's a meaningful value to me of quick close or no close, and I would take something off the top end price. As speaking as a seller, somebody who's owned it and operated it.
And I think we do the same thing. So at Cantex, we go full cycle on investments quite frequently. I think our average hold period right now is about 21 months. So most of our investments are held somewhere probably between 12 and 30 on average. Certainly, we have some that qualify as kind of short-term.
Capital gain, short-term, ordinary income. Jeez.
So you pay the taxman and you move on. But for the most part, I think our average is about 21 months. Okay. So being on both the acquisition side as well as the disposition side, because our entire acquisitions team again stays full cycle from pre-acquisition all the way through post-acquisition, and I think going through that on a large number of transactions, transacting to large REITs, on the sales side, through users that are buying their very first building and everything in between. I think there's absolute validity in saying not every offer is equal when it comes to just looking at the purchase price. There is so many different factors that you have to factor on the sales side that are very important. Timing being a big one. Someone who's done their homework, who's going to invest the time and the concentrated effort to get through DD and get it closed and focused on it, and they're not worried about a million other things, a day
Yep.
job, et cetera, that may be distracting them from focusing on the acquisition of your property. It's important. I think building a track record at Cantex, it's one of those things that we've provided certainty of close. And that surety and
That's huge.
sense of confidence
Yeah.
does allow us to come in and oftentimes buy properties that's slightly less than maybe another offer or competing offer, just because we can provide the surety of close. We have a good track record, and we don't normally run into any sort of issues that would prevent us from making good on a commitment. And for us, our most valuable asset is our time. So we don't want to go under contract on something that we don't fully intend to close, execute, and make good on exactly what's contracted. So
Yeah, and I think again, for people starting off, whether you're the first deal or your third or fourth, that reputation is just inked, every successive time, and it's important. It cannot be understated that you can beat your own chest too and be like, hey, I already own these 3 other properties, and maybe it's taking you 1 a year to acquire them, but you can say these went smoothly. Talk to the brokers. I love that. When people are trying to prove their credibility and say, oh, go talk to that seller, go talk to title. It was smooth. We closed on time. Nothing was my fault. And it's such a small world. I mean, I know that we share service providers and different brokers, and it's a very easy verification, or it's just a checkup of like, hey, I got this offer, from this bozo named Ron. What can you tell me about him? Like, oh yeah, he's got a couple partners, but they're all local. He's gone to the site. He's got local financing, and I think that's the most frustrating thing if you're new trying to prove your credibility is it's difficult. And I think the hardest part for investors, and you tell me if this is true for your journey, nobody is there to teach you about how you should do these things. I mean, you have your boss or you have your partner, you have some guidance, but he doesn't really have any more basis for telling you what to do either. I mean, he's just a colleague in that sense. But how do you learn how to do these things and develop a sense?
yeah, I mean, I think doing your homework and kind of getting smart, watching YouTube videos. I mean, you can literally learn anything on YouTube these days.
I think
But watching YouTube, going through case studies, studying what other, who are the investors, the firms that you're trying to emulate? What is your end goal? How did they start up? Learning their track record, their path of success. What kind of assets did they start out with?
Or
And then
what
how did they
risks
pivot?
did they take, and what was their calculus so that you can emulate it too? Because I think that's a big thing. I look at a lot of the Sam Zells or the related, they took some big risks early on, and they had no money, and then they bet it all again, kind of constantly, and it was just this betting on themselves. And if you're unable to stomach that, it's okay, but understand your trajectory is going to be different. You have to be willing to give up something in order to get something better. It's really interesting if you come up with excuses about why I can't do it, or, oh, I can't take that risk. Oh, I wouldn't be able to pull together $4 million in equity. I'm like, well, is it a good deal? Do you have enough due diligence? Like, what are the pieces? Could it be done? Versus somebody who just comes up with excuses and says, oh, they were doing it in easier time. Oh, that's when mobile homes had zoning. I'm like, people 20 years from now are going to look back at us and be like, you guys were the Wild West. You could do anything. You didn't have to get your, EV certification on every property. I'm like, what is that? And they're like, oh yeah, you got to file for this agency. You've got to show them this. You got to do a survey. You've got to pay this group. And oh, it's a huge pain getting your EV carbon footprint certified. I'm like, oh yeah, we didn't have that.
Yeah, I mean, at the end of the day, I think it goes back a lot to experience and somewhat to data, because you can look at the risk you're willing to take, the risk you're comfortable with stomaching from a deal perspective, from an equity or debt perspective, from a personal liability perspective. If you have the data and you have the experience or the exposure to someone else's past experiences, you're removing the uncertainty from the situation. And then it just comes down to you making that decision on a risk-adjusted basis. Are the potential returns of this particular investment worth the risk that I see on the table? Go through and, one of the things we do within our deal team is we always have someone that's playing devil's advocate. Like,
Oh, really? Okay.
why do you hate this deal? Come up with every reason that you hate this deal, that you don't want to buy this deal. And if you get to a point where you can address, mitigate, or there's a risk-adjusted potential upside return for every potential downside or risk in a deal, you make a decision and you move on. And I think Romy and Sam, the founders of Cantex, would agree. It's like we're learning as we go, and even the more you get involved with deals with the big guys and with some of the larger national, international firms, you realize everyone's making mistakes along the way. It's just, how do you learn from it? How do you pivot? How do you memorialize that and hope that no one on your team or at the firm will make that mistake again? And then you move through the deal and you address it, you mitigate it. And maybe that's the impact of 1 point on a deal level return. But if you learned an important lesson that now you can deploy over the next 100 investments, you paid a price to learn that lesson. And so just don't do it again. But when you're first starting out, you want to make sure you're not making catastrophic or critical mistakes. So becoming, well aware of the situation, the certainties, the risk, and having, important third-party advisors, attorneys, CPAs, brokers weigh in on this stuff. And I think having someone that is specialized in the area, don't just go to, a family attorney that you use forever to help you negotiate a PSA or a lease document. Have someone that does this, breathes this all the time, and is focused on it, is important. And not trying to do everything yourself is also important, and knowing when to ask for help.
Yeah, I try to give that advice. I mean, I think that's all really true, is you've got to pay the first time, and it's maybe even overpaying for some service providers, but your first deal is not necessarily to make money. I mean, obviously you want to make money, but the first deal is to learn. Well, now we can kind of pivot. What's your kind of outlook on industrial, DFW? I mean, this is your chance to kind of what are your predictions for the future?
Predictions.
It can be as micro or as macro as you want.
So, I mean, from an overall perspective in DFW, if you look at population growth in DFW, if you look at all of the growth that's coming to, the suburbs sprawling out kind of in all directions from DFW, we've got massive growth in Fort Worth. You've got massive growth up in Frisco and Salina and Prosper. And then continuing up, basically the transportation corridors, whether that's up 75 to 35, 35W, you've really got massive growth. And all of this population growth is driving the demand for supporting businesses and for companies that are looking at this entire population base as an employee base or potential, workforce. And so I think if you look at the transition, just on the, between work from home versus, work in an office, and that whole transition that's occurred over the last, maybe 2.5 years since COVID, it's changed the world that we live in. I think that the population growth we have now, and if you look at the relative cost of occupancy for businesses being low in DFW, there are so many positive factors that are continuing to drive businesses moving here, and they need space. And
so whether that's corporate users or industrial users?
Yeah, I mean, I think it's probably both, but I think most corporate users that do anticipate moving to DFW, they're really looking at their footprint and what is required to operate their business, how many of their employees can be remote, maybe in their prior location, where they can have part of their workforce, if they're moving from an out-of-state location, that remains there but remains remote. And then they try to hire more of a local workforce here, but they no longer need the same footprint they had in their prior location. Right. I can speak specifically to industrial. I know there's a lot of companies. We're running into companies, and I'm looking and tracking the data of all the tours for all the vacancies that we have in the entire portfolio. And we're looking at, where are these users coming from? I look up the companies that are buying buildings or looking to lease space, and a good chunk of them are coming from out of state. And then you have a conversation, you do kind of an interview and find out more about them. You're trying to establish credibility from a buyer perspective. If I'm looking to sell a property, or if I'm looking to lease to someone, I'm looking at their financials, and I'm looking, at vetting that tenant and making sure that they're going to be a good fit for our project or for our property.
So are these just for tenants that have actually submitted like an LOI to lease, or are you doing this just as a survey for everybody?
We're trying to do this even if someone's picking up the phone and calling a broker. The first initial contact, they made an inquiry. So who made the inquiry? Where are they moving from? What is their business? What do they do? And trying to make sure that we are attracting the right tenants for each building and for each project, because I don't think all NOI is created equally. I think that's probably even more so important on the retail side when you look at maybe a multi-tenant retail facility. But even on the industrial side, we look at, ultimately when we go to sell this investment, a lot of the buyers of our product, and especially our portfolios, they are going to look at the tenant mix, and they may not want, not to pick on particular tenants, but like an automotive user. And so if you put an automotive user in there, even though they're willing to pay the highest rent, the highest price per square foot.
And they may be a very strong tenant, just from a corporate, but it doesn't fit the buyer questions if you want that ultra low cap rate.
That's right. And so, looking at that, but as part of our tenant vetting process, we're looking at financials. You look at financials, what were they paying for rent? I can go look up their old address. Where are they coming from? I know how many square feet their facility is. I know what they were paying. And some of these tenants I'm looking, they're paying 3x what my, proposal went out at, because they're in a high cost market. And for companies moving from the coast or the Northeast or California, where they may have been paying a large per pound per square foot lease rate, they've realized that, well, we're a mail order company. We can ship to anywhere in the United States from Dallas quicker than we could from California or Miami. And so they're looking at that and saying there's no disadvantage to being in DFW. The relative occupancy cost is still significantly below, even when you add in a higher percentage tax rate. So the pass-throughs.
Sure. So you look at net effective rental. I mean, these tenants are sophisticated enough. They're looking at NER and they understand, but it's still lower. So I hear that argument a lot from my coastal friends. And like, oh, but your property tax. I'm like, I don't care. The effective rental is still lower. Who cares how you squeeze the tube? And if anything, I would rather have taxes, because you can protest it and it can go down. It's something that you actually have control over protesting. So
no, I think it's important to look at total occupancy costs. At the end of the day, what does it cost for your business on an annual basis to be in the building, or a monthly basis to be in the building, and does that make sense for your business? And when you really break it down and look at the P&L for most of our tenants, the occupancy cost or the cost of real estate in existing in a space or operating out of a space is typically very low compared to the overall P&L.
Sure. So, labor, number one, insurance, cost of goods, fuel, transportation, those are your top ticket, and then rents like, again, we've had this discussion, and I think at the end of the day, there is more room for rent to become a larger part of the P&L if you have good product.
Yeah, it's something that we're really fighting in DFW right now. And I think, probably any of the real estate asset classes, whether that's retail or industrial, that are passing through operating expenses through a triple net lease structure, they're less so impacted directly, as opposed to maybe multifamily, where it's typically a gross lease. If the property taxes go through the roof, you're not passing that through to your tenants that signed leases over the past 12 months. Now, you do have short-term lease duration, and so you're constantly rolling over tenants, but you can only raise your market rent so much. Again, the tenants that are in your building, maybe on a multi-tenant property or a multi-family property, they can only afford so much rent at the end of the day. They might look at another competing property, or maybe a property that's not as nice, to control their occupancy cost or their housing expense. That happens to some degree. I think in industrial, not only are they looking at their base rent, but they're also looking at the triple net, and they're comparing that. We get lots of inquiries that are looking at our face rate and then asking us about triple nets. I think the firm, and we have a great property management team that does a really good job at building relationships with a lot of our service providers and keeping our OpEx at a very reasonable level, oftentimes well below market norms at each of the properties or within each of our submarkets. And so having that mindset of being aware of, our tenants are looking at total occupancy cost, we may be able to achieve a slightly higher base rent, which helps us on an exit or a sale by keeping operating costs lower, so that the total occupancy cost is still comparable with maybe a property across the street that has a lower base rent but higher OpEx.
Yeah, no, that's a great point. I mean, maximizing NOI for the year that you want to sell, and if you guys do that all the time as kind of like a matter of practice or business, then it's great because you're always ready to sell and you don't have to prepare anything. Well, I mean, I think that kind of wraps up the conversation today. Really enjoyed having you on. I think it was filled with a lot of great tips. Appreciate your insight into what Cantex is doing, what you think DFW Industrial, kind of regardless of all the news, right? If you're a real estate investor, you have to be able to make decisions for a long-term horizon, and that's what this kind of analysis does based on data, based on the market, just the pure lack of supply. I think people talk about oversupply, 12 million square feet in DFW. I'm like, I don't care. That's all Class A tilt wall, 40 feet high. That's not competing with any of my stuff. None of my users are going to go in there and say, oh, Ron, I can go lease this space. I'm like, yeah, what, for $22 a foot or discounted to 20? Yeah, so I mean, there's not a lot of supply, it's kind of regardless, and everything else is getting older.
Yep. And then as construction cost continues to elevate, right, you're looking at replacement cost of existing product, and I think that's when you can really feel good about if you had to start new, your cost of construction would be so far, above what an existing product might sell for. And if you look at rental rates for new product versus existing product that may be rehabbed with a couple of dollars of just make ready, you can make a decision as to where there's a better investment for you. Now, there still are lots of investors that are continuing to build new, especially smaller investors putting up nice projects. Some of these projects I would love to own and love them, and maybe at some point there'll be an acquisition opportunity. But right now we're focused in existing Class B industrial.
That's awesome. Well, thanks again for joining us. If you've made it to this end of the video, smash that like button, subscribe for more commercial real estate content.